So he's happily accepted. So thank you, Gary, for joining us from. So good morning to you. So you can take your time to settle down, share your screen, and then you can just go ahead. Okay. So yeah.
I'm having a little trouble. I just opened my PowerPoint, so I got to see how to share it.
Yeah, in the bottom, just there is something called share. Yeah.
Yeah.
Just click it.
Oh, there
Then,
it is.
yeah, you can. Yeah, we can see it now. We can put it in the presentation mode, and then all is set.
All right, presentation mode.
Yeah, fantastic.
All right, we're ready to go. Well, thank you. I am going to go for about 60 minutes. I know we're running 15 minutes late, so I'll try to end. There'll be some time at the end.
Yeah, you have a full time, 60 minutes. Yeah. Please go ahead.
Yeah. Well, thank you, everyone. If there's not time for Q&A at the end, you can directly send me an email. There's my email address, gcokins@garycokins.com. And you're also welcome if you want to invite me to connect in LinkedIn. So my topic is going to be supply chain profitability and cost management. Abdul Sheikh, thank you very much for inviting me to present. I am presenting from the USA. So who am I? My name is Gary Cokins. I received my industrial engineering and operations research degree from Cornell University in 1971, my MBA from Northwestern University Kellogg School of Management, 1974. So if you're doing the math, I'm 74 years old, but I feel like I'm 44 years old, still young. My career was pretty much in 3/3. My first decade was with a large manufacturing conglomerate, FMC, Link Belt. Then many years as a consultant, 7 years with Deloitte, 5 years with KPMG, 5 years with Electronic Data Systems, EDS, that's now part of Hewlett Packard. And then for 16 years, I was with SAS. Many don't recognize who's SAS. It's SAS. It's actually the world's largest privately owned software vendor, 15,000 employees throughout the world. And with SAS, I retired from SAS, I think 8 years ago. And now I'm just enjoying teaching and some consulting projects. I have been to India 5 times with SAS, Bangalore, Mumbai, Hyderabad, you name it. I've been to almost all of the cities and very much enjoy it. Okay, why are those books there? I believe careers have a lot more to do with luck and circumstances than being smart and competent. I had 2 lucky breaks in my career. My first lucky break was when I was 27 years old, very young. I was a division financial controller in Milwaukee, Wisconsin with FMC. But after a couple of years in that role, I had the opportunity to become plant operations manager. I mean, I have an industrial engineering degree. I'm certified CPIM with what used to be the American Production and Inventory Control Society. It's now been rebranded the Association of Supply Chain Management, ASCM.org, if you want to look it up. So I took that job, and I used the phrase, I then got to eat the accounting data that I had previously been serving and reporting as the division controller. I found much of that information to be at best useless and at worst dysfunctional and misleading. And that was a real wake-up call to me about the difference between external financial statutory reporting for government agencies and internal management accounting used by managers and employee teams to have insights and make better decisions. My second big break was in 1988. KPMG Consulting struck an exclusive contract with Harvard Business School professor Robert S. Kaplan. And some of you may recognize Kaplan's name from the balanced scorecard and strategy map that he co-created with Dr. David Norton, which he did. But he did the early pioneering work in activity-based costing. And so I got recruited to KPMG that had the contract with them from Deloitte. For 5 years, I got trained by Kaplan. For 5 years, I implemented ABC, and then I wrote a book on it. It's not one of the, and that led to writing more books. I am not advocating you to purchase my books. Don't say to Abdul, oh, this guy's pushing his books back. Don't buy my books. What you can do, though, is go to the Wiley garycokins.com website, chapter 1 is a free download. Also, in my website at the bottom, you can see www.garycokins.com. Under the horizontal tabs are many articles, links to many articles and PDFs that I've written. You don't have to pay for anything. So let's get going. Who will benefit from this presentation? Managers who have previously struggled at promoting enterprise performance management, EPM, supply chain management, and integrating business analytics into their decision support systems. Managers who intend to champion any or all EPM, supply chain management, and business analytic improvement techniques, and they need a compelling call to action. And the reason I have champion in quotation marks is it's been my observation that although it's desirable for the senior executives to advocate innovations and new ideas, often they are preoccupied with firefighting and short-term priorities. It's typically managers 1, 2, 3 levels down in the organization chart who are passionate and ask themselves, how long do I want my organization to continue to perpetuate using stale and arcane and out-of-date and flawed methods? And they will do a proof of concept or a pilot project or something I call rapid prototyping to demonstrate and prove to their coworkers that this is the way we should be going. So if you're down in the lower in the organization, that's fine. I like presenting to you. So my agenda, I'm going to clarify first the confusion and lack of consensus about what is enterprise performance management. Then I'm going to describe why our trading partner collaboration in a supply chain, upstream and downstream, needed. Then we're going to have to talk about managerial accounting for supply chain management. And then at the end, I'm going to share a frustration that I have. What is taking so long for organizations to adopt and implement these progressive methods? So let's start with the first one, confusion and lack of consensus about enterprise performance management. Is it human resources performance management? If you just do an internet search on just performance management, most of the hits will be about the personnel and human resources function, like employee appraisals. Is it about scorecards, dashboards, key performance indicators, and measures? Yes, but that's a subset. Is it about the alignment of the employees and their priorities with the strategy of the executive team? Yes. Again, that's a subset. That's the world of the strategy map and balance scorecard from Kaplan and Norton. Is it about process, productivity, and quality improvement? Yes, but that's another subset. Those three are referenced as business process management. BPM is the acronym. So things like lean management, Six Sigma quality improvement, and the like. Or is it all of the above and maybe even more? And the answer is yes. And the good news is this: the enterprise performance management is basically an integration of many multiple methods, like gears in a machine. The problem is when organizations do implement them, they implement them in isolation of each other. So you've got profitability reporting people in one part of the building. You've got supply chain management building in some other part of the headquarters building. You've got enterprise risk management in another part of the building. You've got budgeting and planning in another part of the building, and so on and so forth. The message is you get a lot more power and synergy when you seamlessly integrate all of these methods, like gears in a machine, and even more power when you embed analytics into each method, analytics of all flavors, regression, correlation, clustering, association, segmentation, and the like. So the definition is really, as I've just described, and since I believe you're getting a copy of the PDF of these slides, analytics-based enterprise performance management is the integration of multiple methods with each embedded with analytics, such as segmentation, especially predictive analytics. Make no mistake, the purpose of enterprise performance management is to achieve the executive team strategy and make better decisions. Now, what has caused interest in EPM? I'm going to basically take you through these 8. It'll just take me 2 to 3 minutes. And then the rest of the presentation is going to be 7, supply chain management, which is why we're all here. The first reason there's been interest in EPM in the last 5 or 10 years is executives' frustration with strategy failure. Most executives are quite good at formulating strategy. Their frustration is failure for the employees and managers to successfully implement the strategy. And there's a fair amount of empirical evidence on this. In North America, there is a recruiting firm, an executive recruiting firm in Chicago. Incidentally, I'm from Chicago. That's where I was raised here in the US. And they monitor the involuntary turnover of CEOs in North America, the firing of CEOs. It has been increasing every year. And I believe post Enron, those of you familiar with the Enron, Arthur Andersen collapse, that the board of directors take their governance job far more seriously. So if the CEO is not implementing the strategy, they're fired. A good example would be Carly Fiorina with Hewlett Packard. The board of directors gave her a few years to implement the strategy. She did not. They fired her. Number 2, increased accountability. Today, there is no place to hide. Managers and employees will be monitored. They will be measured. Doesn't necessarily mean that their job security is at risk, but it could adversely impact their salary or wage increases or job promotions. 3, more rapid decision-making. Unlike a few years ago when you could test and learn and have meetings in conference rooms, today people will be on the phone. Go or no go, yes or no. They need to make that decision in real time. They almost wish that an executive was sitting next to them during the phone call so they could ask them, what decision should I make that complies with your strategy? Number 4, mistrust of the managerial accounting system for transparency and accuracy. The reality is most managers do not trust the management accounting from the CFO. They know it's flawed and inaccurate. Why? Because of those overhead cost allocations to products and services. We'll talk about that. Number 5, poor customer value management. The reality is customers are the source of value creation, wealth creation for owners and shareholders. We need to connect customer activities to the shareholder or wealth creation. Unfortunately, though, the CFO is not reporting profitability by customer. They're stopping halfway down the income statement at just product gross profit margin. They're not including channel distribution expenses, marketing expenses, selling expenses, cost to serve. Marketing and salespeople need to know, if you will, profitability by each customer. 6, contentious budgeting. This may surprise you. I think the annual budget process is broken. And my advice is stop budgeting. There I probably caught your attention. But that begs the question, what was the purpose of a budget in the first place? And how might we use some of these enterprise performance management methods to basically create a much superior budget that is capacity sensitive? In other words, we handle the classification of resources as sunk, fixed, step fixed, variable. You got to think like an engineer. I've been an accountant in the accounting world for 40 years, but I still tell everybody I am an engineer masquerading as an accountant. 7, dysfunctional supply chain management. That's why we're here. The issue here is is that most customers view their supplier as the enemy. It's an adversarial relationship. And we'll talk about that in just a few minutes and much more. And finally, number 8, unfulfilled return on investment promises from large IT systems, such as enterprise resource planning systems. And the issue here is, if you ask the IT director, the chief information officer, 2 years after they finally implemented their large ERP system, you ask that person, the IT director, how well do you believe the return on investment from buying this ERP software has met or exceeded the ROI, return on investment, that the software salesman sold you on 2 years ago? Most IT directors will say, I'm not sure. I don't think so. We've just spent 2 years implementing this ERP system. A lot of expense, a lot of investment. I'm not sure we've got the payback. That does not mean you should not implement the ERP system. You have to, because your competitors all have it. You've got to stay even with them. But the issue here is that ERP systems produce a lot of data. They're transactional, but not information. Data and information are not the same thing. Data tends to be transactional. Invoicing systems, purchase systems, payroll systems, all those transactions. But you convert the data into information for insight. So let's get going here. Let's now talk about supply chain management, number 7 on the list. And incidentally, much of this presentation is coming from a book that I co-authored with 2 university faculty at the University of North Texas in the Dallas, Texas area. You can basically get a link to, I believe, chapter 1 to get an overview. Excuse me. So here's some of what's written in the book. Post-ERP and supply chain management challenges. In the 1990s and 2000s, businesses embraced ERP and supply chain management to automate relationships and increase efficiencies. So these changes either eliminated some cost or they shifted the cost to upstream or downstream trading partners. But they didn't address these 3 key challenges. The first one is the adversarial relationship. Many customers view their supplier as the enemy. Oh, let's just pound on the supplier. Let's negotiate a lower price. If we put that supplier out of business, so what? We could always get another supplier. This has got to stop. It needs to be a marriage. Supply chains are competing against other supply chains for a share of wallet or share of purse. So while each trading partner knows that there are mutual profits to be gained, decades of arm length and adversarial behavior has precluded those efficiency gains. There's the pressure. It starts all the way at the end and it comes all the way, to the initial supplier, at taking dirt and earth out of the ground. Another problem is a suboptimal internal focus. It is no longer sufficient for your organization to be the most agile, lean, and efficient firm. You are dependent on all of your trading partners, upstream and downstream, to also be agile, lean, and efficient. You're all part of this chain that are working together, competing against other supply chains. So this eventually creates the need for collaboration, communicating and looking for mutually beneficial opportunities between trading partners upstream and downstream. But first, you need to know the facts. You need to know what your costs are, or the profit margins are, and who or what is causing these costs. And that leads us to have to understand some management accounting techniques. So this is going to be a little bit like a college professor. I'm going to train you. But to introduce it, here's a quote from, if you're familiar in the US, Walmart is a huge, if you will, big box store. And from the retired supply chain manager, he said, many companies may find it near impossible to track supply chain costs, but it is a requirement for properly tracking, reporting, and measuring item performance. And it is a true prerequisite for advanced supply chain and retail optimization. So a way to visually look at this is, we've got here's the chain, from the sources all the way to the consumers at the end and all of the trading partners in between. But in the intersection between a customer and a supplier, the buyer and the seller, I call this the information conduit. So the starting point to measure profits across the supply chain and to identify those joint mutually beneficial opportunities begins at any one of those seller-buyer interfaces along the chain. And the technique to really get this is really activity-based costing. So and I understand some of you may say, oh, I don't think ABC works. It does have a bad reputation from the past, but that's because the systems were too large, too complex. No one could understand them. They were not maintainable. ABC really does work. And I'm going to explain it now. Here's a simple way to understand it. Imagine you go to a restaurant with 3 other friends. You order a little salad, and the other 3 order the most expensive item on the menu. And at the end of the meal, when the waiter or waitress brings the bill, the other 3 say, "Hey, let's split this check evenly." How do you feel? Not fair, not equitable. Well, that's how products and standard services also feel in a traditional general ledger standard cost accounting system when the accountants take this large amount of indirect expense, commonly called overhead, and they allocate it like spreading butter across bread using cost allocation factor denominators like number of labor hours, number of units produced, square feet, square meters. None of those cost allocation factors reflect the unique consumption of the diverse products of the end-to-end business processes and the work activities that belong to those processes. So if the accountants were to decompose that big, large overhead pool, which is typically 50% of the expenses, the other 50 is direct, if they were to decompose it into multiple cost pools and trace and assign each activity with the cause and effect relationship, you will discover that in reality, compared to that butter spreading, some of the products were way overcosted, the others were way undercosted, because it's a zero-sum error game. That means the accountants are providing flawed and misleading information to the managers. Yes, it will reconcile exactly to the euro or the dollar or whatever the currency is for the auditors, but it's wrong in the parts. So the definition of ABC is as if the waiter or waitress brings 4 individual checks. You only pay for what you consume. Now, the reason there's been interest in ABC in the last 20, 30 years has to do with this diagram. It has the 3 universal components of any organization's expense and cost and profit relationships. We've got the direct labor at the bottom, the direct material in the middle, and then the overhead, which is better referred to as indirect expense at the top. And notice over the decades, the indirect expense is displacing the direct expense. And when you ask managers and executives why, they'll say, well, automation, computers, technology, we're automating out the frontline workers. That is secondary. The real force that's causing this displacement is over time, all organizations have had an increased proliferation of different types of products, manufacturers, more colors, more sizes, more ranges, more types of SKU stock keeping units. And the point is this, whenever you increase the diversity and variation of the outputs, it just produces complexity. And the complexity causes the need for more and more indirect expense to basically manage it. So 20, 30 years ago, when it was like homogeneous product, let's imagine it's just a black pen factory, most of the accuracy came from the direct material and labor costs. The indirect was small, so you had a little bit of error. But now imagine that factory is not just black pens, but it's 40, 50 colors of pens. Imagine looking at that warehouse now in your imagination. Look at all that complexity, all of that indirect expense. That's why we need activity-based costing to trace and assign it. Now, how does ABC work? Focus on the first diagram to the left. That's the traditional responsibility center statement. Every manager in the planet Earth recognizes that report. Salary, equipment, travel expenses, and so forth. But at the bottom, I say when managers get this kind of report, they are either happy or sad, but they are rarely any smarter. When you get that report, a manager asks themselves, how much insight and understanding do I get about the cost that I can influence and control? Not much. What ABC does, look, we now go to the middle slide. The same 914,000 is now recast in a different, if you will, language, the language of work. Key scan claims, analyze claims, suspend claims. Notice I'm using the back office of an insurance company. It's a factory too. And then we reassign each activity cost to the products or to the customers, just like the waiter or waitress in my example in the restaurant, based on a cause and effect relationship. Those are what we call activity drivers. Now, what is a surprise to many managers is before doing ABC, when you ask them, where do the expenses in your company start? They say at the left side. But after activity-based costs, and they realize, no, your expenses actually begin at the right side of this diagram. The products and customers place demands on the workload in the middle. The workload then draws on the capacity, spending on the left, and the costs measure the effect in the opposite direction. So demands on work flow right to left, costs flow left to right. It's a principle. Rules are many, but principles are few. Principles like gravity or speed of light, you can't alter gravity, but the accountants violate the principle of causality when they do that butter spreading of the overhead to the products. Now, I've rotated the previous diagram 90 degrees to the left. It's not as simple as you just take our ledger expenses, we put them into these activity cost pools, we trace them to the products. The reality is the right side. It's a multi-stage assignment network. Why? Because you have support activities that are supporting other support activities that are in turn ultimately supporting the frontline activities that interact with customers or make products. So it needs to be multiple stage. Now, the next slide is going to look complex. I'm going to go through it briefly, but I will be providing you a link to a 30-page document that I wrote that will explain the diagram at your leisure when you have more time. So here it is. Don't be too shocked. Here's the way it works. We've still got the three universal components of any organization's expense and cost structure. We have the resource expenses at the top, salary, material, phone, travel, rent, all that. We have the work activities in the middle, and then they eventually pile up in the bottom into the products, services, customers, and something we call business sustaining. I'll get to that in a minute. Okay, all of those arrows, think of them as thin straws or wide pipes where the diameter reflects the amount of money flowing through. That's why this will always reconcile exactly. So if the organization spent, let's say, 200 million of euros in January, it will be the exact same 200 million euros of work activities. And the 200 million will pile up in the bottom two right boxes, customers and business sustaining. That box is called the final cost objects. A way to think about these final cost objects is like the predator food chain. Large mammals eat small mammals eat plants. So notice there's the customers. In fact, they're taking some direct expenses, marketing expenses, selling expenses, but they're also buying the products. So see where the products are going into the customers? That would come from the sales volume and mix register. Business sustaining is a special category. There are going to be some expenses that have nothing to do with making products or delivering services, things like the legal department. So we create a final cost object like senior management. Those cannot be allocated to products or services, okay? It's typically about 10% of an organization's monthly expenses. Now, we reverse all the arrows in your mind, reverse all the arrows so they're going the opposite direction, they're going from the bottom to the top. That is what's happening every minute, hour, day, week, month, year. The customers and the products are placing demands on the workload's drawing on the spending and capacity, the costs measure the effect in the opposite direction. So the real message here is costing is modeling. Costing is not T accounts and journal entries that an accountant uses in their, if you will, bookkeeping. Also notice in the middle, we've got people activities and equipment activities. Men and women run machines, machines make products. Men and women drive buses, buses deliver passengers, okay? Even equipment assets also do activities. But again, costing is modeling. Now, direct material, direct cost, not broken. You may have data integrity issues there, but you can work on that. Now, I mentioned because I went through that diagram quickly, some of you said, oh, he went too fast, I didn't understand it. When you get the slides, I think you'll be able to click on the link at the bottom. It's an article, it's a paper I authored for the Institute of Management Accountants. I'm a 30-year member of the IMA in the US. They are 140 countries, 150,000 members. There's a big group of IMA in the in India. In fact, if you go to Miles Education, I don't want to do a promotion for Varun Jain, he's the CEO and founder. You can read about certification with the IMA, but that link will take you to our paper that'll explain that diagram. What's more important, what's the consequence when you do ABC? Now, the vertical axis is the magnitude of the error between traditional butter spreading, flawed and misleading, and ABC. Now, the horizontal axis, see, that's the traditional, if you will, allocation, the bad way of doing it. The reverse backwards arrow, or S curve, see the ABC, what it's demonstrating is to the far left, for the simple products and services, they in reality have been overcosted when you're using that, flawed labor hours, number of labor hours or units produced. It's really hidden profit. That's like you in the restaurant ordering the little salad. To the far right, though, it's the more complex product, more colors, more sizes, more ranges, that basically are disproportionately consuming the indirect expense. So they in reality have been undercosted using the volume approach. So they're really a hidden loss. The consequence is this: for the ones that have been overcosted, since you have the belief that they cost more, you price them to make a profit, but that's really, they've been overcosted. So your competitors may come in with the price 5%, 10% below your price. They're going to steal, grab market share from you. On the opposite side, it's worse. The sales force believes that some of the complex products are very profitable. And so, they try to sell more and more, but in reality, they're unprofitable. So the more that they sell, the more you lose money. This is how serious activity-based costing can improve, impact an organization. Now, here's the other impact. You're looking at a real diagram of real information. The vertical axis is the net revenues minus the properly calculated and traced ABC costs. The horizontal axis is the cumulative buildup of the products, but it is rank ordered starting with the most profitable product, the second most profitable product, and so on and so forth, left to right. The very last data point at the bottom, at the right side, will exactly reconcile with the income statement. So in this example, the company had quarterly 30 million in expenses, in revenue, 28 in expenses, the net out at 2. That last data point is exactly that too. There is always organization shock when the management team sees this graph. This graph is typically referred to as humpback whale because it looks like a humpback whale in the ocean. Because in this real case, it said you made roughly $8 million of unrealized profit on 3/4 of your products. You lost $6 million on the remainder to net out at 2. And they're always in shock because their belief system before seeing this ABC graph is this graph would look like this blue line. And what's happening is all that broad brushed, average butter spreading is crushing and suppressing any accuracy. But ABC is detecting all the accuracy, and that's gives us the higher line. Now, some may ask, well, what do we do about those unprofitable products on the right? Do we abandon them or drop them? No, that could be a mistake because in some cases, some products are bundled with others. Things like blades and razors. You sell the razor deliberately at a loss, but you make it up with the blades. But the point is this: the top line graph is fact-based data. And if you remember anything from my lecture here, remember this: in the absence of facts, anybody's opinion is a good one. In the absence of facts, anybody's opinion is a good one, but usually the biggest opinion wins, which is the opinion of the boss or the boss of the boss. So to the degree those executives are making decisions on gut feel or intuition or flawed and misleading information like the blue line, your organization's at risk. Now, some of you may be saying to yourself, Gary, you're beginning to persuade me that we should be implementing activity-based costing at my organization. However, my understanding is it would be big. We'd have 3,000 activities. It'd be a mudslide of data. Every manager and employee would have to fill out a timesheet, and employees hate timesheets, and all those other reasons why not to do ABC. They're all misconceptions, but that's what people believe. I came up with the technique many years ago to implement ABC in 3 weeks, and here's how it works. It's called rapid prototyping with iterations. You start with model 0, a 1-day workshop with just 5 or 6 people in the room. You construct the ABC model very quickly, all based on estimates, percentages. Its intent is not to provide any useful or accurate data. The morning of the second day, you now bring in the executives and the managers. They see the model. It's very engaging because it's your own company. The light bulbs go on with everybody. Oh, that's how we can understand our profit margins and so forth. You get buy-in. A couple of weeks, you do a few iterations, model 2, 3, in 3 weeks, you've got a permanent, repeatable production system. Make your mistakes early and often, not later when the system is too hard to change. Now, the reason this rapid prototyping method works has to do with this diagram. The vertical axis is the accuracy of what you want to know. Let's say the true cost of an SKU, stock keeping unit, or a product. The horizontal axis is the administrative effort to collect the data, calculate the data, validate the data, report the data. And you'll notice you will always get what's called an asymptotic curve, which means the accuracy goes up relatively quickly, and then it begins to level off with diminishing returns on extra accuracy for the extra level of effort. What rapid prototyping does is it allows you to get this black slope, the thick one. The accuracy goes up really quickly. You get to 90% and then stop there. Good enough. You don't have to make it a larger, more complex model because this is management accounting information. This is not the financial external statutory reporting. Yes, it's true. For the external financial reporting, if the CFO gets the numbers wrong, they go to jail. But if they get the management accounting numbers wrong, they don't go to jail. So, you don't have to have the super precision. It's a much more practical way. I love this cartoon. It's got an answer board. You see this side. To the left, answer is simple but wrong. To the right, complex but right. Look how many CFOs and accountants are taking the left path. Oh, it's easy to just use number of labor hours or units produced as a denominator. It's so simple. We'll just use that ratio, even though we know it's overcosting and undercosting simultaneously. Taking the right path is worth the effort, more correct. And look at on the left path, look how many are falling off the cliff. The company's going bankrupt because they've got bad information. Now, let's talk about customer profitability. The only value a company will ever create is the value that comes from its customers, the current customers and the new ones acquired in the future. To remain competitive, one must determine how to keep customers longer, grow them into bigger customers, make them more profitable, and serve them more efficiently, and acquire relatively more profitable customers like your existing profitable customers. But we've got a couple of problems here. The CFO and the accountants are not calculating customer profitability. They're stopping halfway down the income statement at just the product gross profit margin line. So what about all the other calculated costs? Products and standard service lines are not the only thing which accountants should compute costs for. What about all the costs that have nothing to do with making the products and delivering the standard service lines? The problem with traditional accounting's product gross profit margin reporting is you don't see the bottom half of the picture. What I mean by the bottom half, I mean, distribution expenses, selling expenses, marketing expenses. Visually, what I'm describing, if this entire rectangle is the amount of money, let's say your company spent in January, the accountants are only calculating the shaded area, direct material, labor, and indirect. It would be nice if they were using activity-based costing principles to reassign the indirect cost. But what about the distribution, sales, and the white space? I'm going to make a case that the white space is more important than the dark space. Now, we've got a couple another issue, angel customers and demon customers. What do I mean by this? I'm going to refer to them as high maintenance and low maintenance customers. Every company has high and low maintenance customers. Example of a high maintenance customer, always changing the delivery schedule date, always demanding special not standard products, always returning goods, always calling help desk. Low maintenance customers, those are the angels, we love them. They don't do any of that stuff. Only by standard, never change delivery schedule, never call help desk, never return goods. If those two types of customers at the extreme bought the same volume, same mix, they are not equally profitable because the high demanding demon customers is causing you so much extra expenses that at some point they're actually unprofitable despite how much they buy from you. So the message here is sales amount volume is not proportionate to profitability. What caught my attention though with this book is the subtitle, Discover Which Type of Customer is Which and Turbocharge Your Stock Price. And what that means is we really need to connect, if you will, customer activities to shareholder and wealth. Now, this is a decomposition of the multi-stage cost assignment network. Remember, I mentioned if you download that PDF, the 30-page document, you can see the decomposition. But the message here is when we go left to right from the activities come into the final cost objects, layer by layer like an onion skin, the profitability is being calculated and reported. And that gives us a profit and loss statement for each customer. And you can see all of the layers. Now, in this fictitious example, notice at the 30% level, that was the product gross profit margin for the mix of products that this fictitious customer bought. But between the 30 and the 8, 22 more points of profitability are eroded, nothing to do with the cost of the products, all having to do with channel selling and marketing expenses. And so if you calculate these two broad swaths for every customer, you can put them on a grid that looks like this, where each circle intersection is a customer. Now, the vertical axis is the product mix gross profit margin, high to low. And the horizontal axis is the cost to serve, the angels on the left, the demons on the right. And now things become obvious. The most unprofitable customers are in the lower right because they're buying low margin profit mix from you and they're difficult to serve, demanding all that extra work. The most profitable customers are in the upper left because they're buying high margin mix and they're easy to serve. And now the name of the game is move the dots from the bottom right to the upper left, but now you've got the facts. And Abdul, that would be a webinar or presentation from another speaker than me, because the move to dots, an example would be unbundling and fee-based. If they're causing you extra work, charge them an individual fee. The airline's been doing it with baggage, or if you want to move from a middle seat to an aisle seat. So the message here is there is a shift in the CFO's responsibility. The CFO must now help the sales and marketing team to better target customers. The spending budget for sales and marketing is critical, but it should be treated as a preciously scarce resource to be aimed at generating the highest long-term profits for wealth creation for the shareholders and owners. So this means answering questions like, which type of customer is attractive to newly acquire, to retain, to grow, or to win back? And which types of customers are not attractive to go after, that are actually unprofitable? And for the customers that are attractive, the second question is, how much should we optimally spend attracting, retaining, growing, or recovering each customer microsegment. And I have optimally in italics. Why does it become an optimization problem? Here's why. Remember the subtitle of this book, Discover Which Type of Customer is Which and Turbocharge Your Stock Price? Well, there's two ways you can destroy shareholder wealth, okay? You can destroy it by first overspending unnecessarily on loyal customers for what is needed to retain them. So they would have still bought over the last fiscal year the same amount, same mix, despite how much you give them coupons, offers, deals, and wining and dining them. But you can also destroy shareholder wealth on the other side by underspending on marginally loyal customers and risk their defection to a competitor. So if they feel that you're not paying any attention to them and you're just ignoring them, they're going to look for a competitor that's more aggressive. So the message here, what is the optimum spending level? It's like you go too much or too little, and the accountants are in a good position if they would master some of this advanced managerial accounting with activity-based costing to do it. But sadly, very few are. And Abdul, I'm going to now make an observation and deviate. In India, there is a problem. There is way too much emphasis on statutory reporting for the government agencies. The magnitude of activity-based costing in India compared to other countries is relatively low. The CFOs and the accountants in India need to step up to the bar. They're underserving their internal line managers, all because their emphasis is statutory reporting. I don't know what the deal is with the government in India, but they're important, but the internal managers are much more important. Now, you can also use ABC in an alternative way to look at the process view. Each of these, notice in each of these departments in the middle, each X is an activity. So what I just showed you was the multi-stage cost assignment network. We're tracing each activity to the product, to the type of customer type of order using the activity drivers. It's strategic. We get profitability measures. But notice we could also string each of the activities in those departments like pearls in a necklace horizontally. And that then would allow us to get what's called a value stream map. So this is where the lean management, lean accounting people basically are headed. So notice in this value stream map, the height of each activity is the amount of this expense. And then what they like to do is tag or score each activity as value added or non-value added or maybe somewhere in between. So the point here is you can have two or more management accounting systems. You can have the vertical reassignment ABC for strategic pricing and profitability reporting, and you can have the horizontal process view. They're all valid. ABC provides also unit costs. So I'll start concluding. This is my big frustration. How to get buy-in for the methods I just described for supply chain management. Why has the adoption rate for enterprise performance methodologies with the supply chain management been so slow? Why is this? What are the barrier categories? There are three. The first one are technical barriers, and they're IT related. They could involve like what we call dirty data. Someone put in, the wrong information at the beginning. And so, but IT has a technique called extraction, transform, and load, ETL. It's a way of like purifying the data. Another technical issue, if you're multiple divisions like Reliance, big company in India, and I've been to their offices or to some of their divisions several times. They may have multiple hardware vendors. They may have Dell in one factory, they have IBM equipment in another, Hewlett Packard. IT can fix that. The second barrier is the perception that it's way too complicated. It's not affordable. Like I mentioned to you about implementing ABC. Most CFOs go, oh, I don't want to do it. It'll take us 6 months. It's not worth the effort. Also, I don't want to have two sets of books. That'll confuse people. I've got one set of books for the external reporting, another internal, all of that. That can be solved with rapid prototyping and iterations. But the biggest barrier, the third one I'm going to show you, has nothing to do with technology, nothing to do with systems, nothing to do with software. It's all about people. It's organizational behavior. And it starts with resistance to change. It's human nature. People like the status quo. Only babies like change of their diapers. But other people-related issues, fear of others knowing the truth. Oh, I don't want to do ABC. I don't want other departments to know what my costs are. Fear of being measured, fear of being held accountable. Notice all of those have nothing to do with technology or systems. It's about people. And I'll say the last one, weak leadership. Not every organization's executive team has the highest IQ. So the point here is to really successfully implement these techniques, you need soft skills, behavioral management, change management skills. And very few accountants have that. You, and even me in the beginning, what are we? We're what I call Newtonian managers, like Isaac Newton, the physicist. To us, the world's a big machine. Give me the levers, the pulleys, the dials. You need to have some Darwinian, like Charles Darwin, the biologist, sense and respond. It's people. You've got to overcome their resistance, and there are ways to do that. So let me conclude. Your success depends on how well and how fast the right information and intelligence gets to the right people. There's 4 of my books. Again, you do not need to purchase the books, but if you go to the Wiley website or just do a search, most of them, chapter 1 is a free download, and that's all you need. Also, again, to reiterate, my website, see in the bottom left, www.garycokins.com. There are horizontal tabs in these different categories of BPM. Below them are links. It's all free. You do not have to purchase anything from me. So thank you very much. There's my website. Also, you're more than welcome to invite me to connect in LinkedIn. And Abdul, I know you're running late, but if there are...
Yeah, thank you, Gary. Thank you. Wonderful presentation. I hear this a long time, but I still see it's a very fresh concept. I see I just noted down all the points, the key things, you just put them on the presentation. Okay, so I have one point. One more point to add to that. If some people, we can convince them that activity-based costing can be used, and the problem is if they don't do it properly, okay, then that will create a bigger problem. Okay, so that could be that is something which management is afraid of deploying it. They need a right person, somebody like you who to guide, who knows exactly how to do this activity-based costing, how to define activities, how to define activity drivers, and then do it in a practical way. If you do it in a wrong way, then it will become another problem. Okay, so I think do the ERP requirements given by the functional managers, like accountants, accounting manager, sales manager, blah blah blah. They have to consider, okay, so the data requirements of activity-based costing at that point of time. Because if you don't do that, what happens is you cannot really extract data naturally from the system. But if you define the scope while doing the ERP implementation, you can get all the data very easily. You don't have to worry about it. But the big problem is while giving the requirements to the ERP, either they're too excited or they're just too reluctant. So that creates a bigger problem. Only very few, maybe marginally, maybe 2 or 3, maybe 10, maximum 10% of organizations, they give a clear-cut requirements from the real business requirements. Instead of writing whatever they have in my mind, they will, instead of writing it, exactly they need to brief it. Okay, in our experience, one example, the sales price, shall it include transportation cost or shall it does not include transportation cost? So we put it wrongly. Then later when we want to do the profitability analysis, we were not able to do the profitability by customer. So this we have to redo it. Okay, it is not something easy. So this is a fantastic concept. Okay, I think still we can promote the concept from the technology point of view if we embed this into solution itself. Yeah, let us try. Like, let us try again. Maybe we will try to do more knowledge transfer to the senior people to get buy-in. Yeah. Mhm.
Well, let me make a few comments. I totally agree that if the initial ABC model is poorly designed, it's going to be the same kind of problem with the flawed method. This is why the rapid prototyping with iteration allows you to make corrections each iteration. Also, for any of the individuals attending this that are from a consulting firm, whether it's EY or PwC or whatever, feel free to contact me, because what I enjoy doing now is training you how to implement this for your clients. My days, I'm not ready to fly anymore. I'm 74, but I like doing knowledge transfer, and I can explain to you, actually instruct you, teach you how to do the rapid prototyping. Now, your other point, Sheikh, is leaving out things like distribution expenses. No, those do need to be included. Oh, one other observation. I understand there is one large software vendor, and I'm not going to name it so I don't get in trouble, in India, that is the dominant ERP software vendor. And some of you may be saying, oh, golly, how do we put the ABC module for that vendor in? The way I've seen it here in the US is you start with a commercial ABC software vendor. There's about 10 of them. I have, if you want to know, just send me a list. And they're really good calculation engines. And you can start getting the return and the profitability and the decisions and so forth with it. Then, when you now need to migrate into the large ERP vendor, and I'm not using their name, although I'm tempted to, you've already done the data requirements definition, Sheikh, that you're already asking. So it really makes the transition into the large ERP vendor relatively easy, because one, you've already done the data requirements definition with the commercial ABC software, and they're not that expensive. It's a throwaway. You buy it for whatever and then you get returns because you're starting to make better decisions from that vendor, and then you throw it away and you migrate over to the ERP vendor. So I think we're out of time here, but that was comment to your comment, Sheikh.
Yeah. Thank you, Gary. It was a fantastic session from you, and it's a learning experience for us. Okay, we will try to think more about EPM and read your books going forward. Yeah. So thank you, Gary. Thank you very much.